Hi, I'm Keith McCullough. Welcome back. I'm here with a senior partner at the firm, Howard Penney, who runs our restaurant business, who's been very vocal about Darden Restaurants, both on the short side of Darden last year and this year in terms of owning the debate, like we like to say here at Hedgeye, on Darden potentially turning itself around. So to start with that, Howard, are they turning themselves around?
No, they are not. They're pretty far from it, actually.
So today's numbers, were they bad, real bad?
Disaster. I think is a better way to put it. Missed the numbers, guided down. Same-store sales at Olive Garden were actually okay. Same-store sales at Red Lobster were a disaster. As the concept's been a disaster for quite some time.
And the Red Lobster is not the crown jewel?
No, it is not the crown jewel. But for Canada, it might be.
Yeah. For those of you who don't know, my mom loves the Red Lobster. As anybody who lives in the northern part of Canada who's never seen a lobster before loves it. But the reality is that people in America don't love Red Lobster right now.
The value proposition in America is just not what it used to be. It's a very expensive chain. It's an occasion restaurant, and people aren't going there very often.
So what is their solution to this?
Spin it off. Get rid of it.
Get rid of it.
Get rid of it. Yeah.
So Clarence basically says it's a disaster. I just got to get rid of it.
Correct.
So that doesn't quite fit the turnaround plan.
No, not our turnaround plan that we laid out back in March. I mean, we've got a much, I think, a better plan, if you will.
And it's probably worth spending. Actually, let's go through the operating margins. How good or bad were they, and then we'll go through.
Yeah. So the margins are down 100 operating margins. So enterprise-wide, down 140 basis points, I believe, 150 basis points in the quarter, and have been in a secular decline for years. And the margins now are well below their peer group, despite having very high average unit volumes.
So, I mean, for those of you who don't know, that's really been a Hedgeye playbook short. So, in other words, sophisticated analysts like Howard, who knows his group really well, is looking for two things. He's looking for the top line to slow, or sales to slow, in the case of the Red Lobster go negative, and operating margins to start to compress. And that's effectively what's happened here. And that's why you're saying, hey, look, you guys have to figure out a better way for this platform. So could you just kind of review your view of what they should do versus what they're doing?
Well, it's become too big to perform. So they have 8 brands, and you can break up the brands into Italian, seafood, and steak. And that's what I think they should do. And it's just a company that has excess G&A. There's lots of fat. And they need to cut the G&A. They need to break up the companies into 4 companies, or break up the company into 4 companies. And it'll allow for a streamlined organization, streamlined companies, and it'll get a better valuation, and it'll certainly be, operated more efficiently.
Well, I mean, when you say that, because you and I have followed the group together for a long time, you've made this call with other restaurant companies, over and over and over again. It's like the playbook call with Brinker and Chili's, getting smaller in terms of the number of brands. What is it about this company that they don't get this strategy?
I don't know. I have to say, I don't know what it is about Clarence why he doesn't get the strategy.
Clarence is the CEO, Clarence Otis, who is a bit of a problem.
Yeah, well, he's caused a problem, that's for sure.
Yeah.
And the question is, will he fix it, and will he do it the right way? And he's not. I mean, he clearly, after today's announcement, is going down a different road. And he should do what I think he should do, is come up with my plan. But my plan is not unlike what Starbucks did, what McDonald's did, and what Brinker did. I mean, it's just focus on doing one thing right. I like to say McDonald's is the biggest restaurant company on the planet for a reason.
Yeah.
They do one thing right.
Yeah, they don't. It's interesting, like, back to Clarence. So Clarence today, I'd say that it was relatively aggressive what he did in terms of what he announced relative to what Barrington may have wanted, what you may have wanted. Can you kind of go through his thinking, why he might be doing what he's doing? What is he doing?
I couldn't go through his thinking. I mean, it's illogical to some degree.
Well, isn't it logical if you think about it? Like, Clarence gets paid a lot of money. He's the chairman and CEO of the company. He's got a ton of control.
Right. I think, like you like to say, it's a CYA move. That's your firm, I think. But no, I mean, he's protecting his job. I think he really is. I mean, he's doing what he needs to do to get the company to the next level, or to at least to save his job through next May, which is when their shareholder meeting. And what he also did today is basically told the activist shareholder Barrington, to go away. I mean, we don't like your plan. We don't think your plan creates value, which they're not happy about.
Which isn't nice at all. I mean, Barrington, by the way, was very friendly towards who we would say is probably not one of the better CEOs out there.
Right.
What do you think Barrington, or put another way, what would you do between now and the shareholder meeting? Is there anything to do?
So I'm going to continue to do what I think is the right thing for this company to do, and is to streamline it into 4 companies: an Italian company, a steak company, and a seafood company. I mean, That is the right thing for this company to do. Whether they get there or not, who knows? I don't think Clarence is going to get there, and I think ultimately someone will come in and take this company down the road it needs to go.
Which is, the market typically makes the ultimate vote on this, folks. And at the end of the day, you look at this stock, it's down a lot today, but moreover, it's breaking what we would call our intermediate term trend line of support, which is just north of 51 a share. So again, the shareholders are not going to be happy with this. Clarence is out there, he's cutting CapEx to pay the dividend. That is what it is. That is not an offensive turnaround strategy, which Howard has in plan, which Barrington has in plan. Offense, not defense. Defense is, again, plugging the holes, trying to pay this dividend, and we're betting here that the shareholder base is not going to be happy with that. If you have any questions on this, I'm at Keith McCullough. That's my Twitter handle. You can find Howard. He's very prolific on Twitter in the restaurant community. It's at Hedgeye HWP for him. If you have any questions at all, please tweet us.